For more, let's bring in Ann Sonders. She's the chief investment strategist at Charles Schwab. You know things are changing, Ann, when you start to see the new monikers to try to group things together for the new. Nothing seems to be getting in front of this AI trade, though.
Yeah, no, but I think there's more discernment in terms of what does well. And you're right, the monikers do change now. I've been hearing more of the Mag 3 earlier this year instead of the Mag 7. Lots, including us, were calling it the Lag 7 because they were the underperformers during the near bear market that happened, at least in the case in the S&P. So yeah, it does change. I think you're seeing more dispersion in general in the market, certainly within some of these prior, darlings of cohorts like the Mag 7, but there is absolutely an AI angle to all of this, especially as it relates to CapEx. It's kind of this bifurcation.
We were talking a little bit about this last hour, but there are these overlay charts comparing their performance to the NASDAQ back in the dot-com era. Torsten Slok earlier this week had a piece kind of warning that the S&P 500's biggest companies could be at risk from the AI bubble, as he called it. Do you think this is a bubble or not?
Well, I think we've got excess from a concentration standpoint, and I think that is a risk for a lot of particularly individual investors that may not have been adopting a balance sheet strategy. The one big difference is that even though valuations are similarly stretched, the underlying fundamentals are much stronger. A lot of what powered the late 1990s, aside from some of the big dominant mega cap names, were stocks of companies with no profits, no prospects for profits. It was sort of silly season with .com being attached to everything. I think when you look at the underlying fundamentals, leaving the valuation piece of it aside, these are real companies with real profit streams and a pretty bright future. You get to a valuation excess, which actually we got to in the early part of the year, and part of the reason why many of those stocks underperformed the S&P on the way down. Those excesses need to be corrected, but I wouldn't do an apples to apples in terms of that .com era because the quality of the companies from a cash flow perspective, from a balance sheet perspective, are far superior.
It's much also different, Ann, than 1999 because a lot of the companies that powered the market back then, and sadly I remember it, were companies that were new. They weren't NVIDIA, they weren't Apple, they weren't Microsoft. Those companies have been around for 20, 30, or 40 years. They were the CMGIs, the ICGEs, Commerce Ones, Aribas. They came and went in a matter of years. Many of them went away. Are there, though, any similarities between now and then?
I think there's some sentiment froth. Again, the concentration problem, when you look at whether it's the top 5 names, the top 10 names as a share of the overall index, we've actually exceeded that now. If you look at things like the Buffett model, which is total market capitalization of all stocks, not just the S&P, not just the big as a share of GDP, that has exceeded the highs that we saw in that 1999-2000 period of time. Households' exposure to equities as a share of their overall assets is higher than it was back in that period. So there are some similarities, but you're right. It's the nature of what the companies are, their longevity, their success, their balance sheet, their cash flows. That's where I think that there is a notable difference. And there were players back in the late 90s that survived. We just had
Amazon was one of them, by the way.
Amazon, Microsoft has been around for a long time. You rightly point that out. But that doesn't mean you don't get frothy excess. It requires a corrective phase, even if it's just a valuation correction to allow the earnings stream to catch back up to rich valuations.